On the 31st of January 2020 at 11 p.m. UK time, the United Kingdom left the European Union after 47 years of having been a member of the EU and earlier of the European Community. 11 months later, Brexit was completed, with the UK also withdrawing from the European Customs Union and the European Single Market. Quoting the European Commission, this episode created barriers to trade and cross-border exchanges that simply did not exist prior to the 1st of January 2021. Here at the Florence School of Banking and Finance, we have been analyzing the impacts of Brexit on the EU financial industry and the European project of building a capital markets union in a podcast series with Jean-Jacques van Helten, visiting fellow at the Florence School of Banking and Finance, Robert Schuman Centre, the European University Institute, and formerly a managing director and chief risk officer at the Bank of Montreal. Today, we have the pleasure of hosting again Jean-Jacques for a final podcast, analyzing this time the impact of Brexit on the regulatory framework and on financial markets, both in the UK and in the EU.
Good morning, Jan. Likewise, it's the end of a series of podcasts that I've been doing, and look forward to sort of considering where next now that Brexit has become a reality.
Excellent. So, to kick off this discussion, could you please remind us, before talking about what is happening next, about the scenario in which Brexit happened, and what was at the time the status of the UK-EU relationship?
Thanks, Jan. Yeah, so effectively on the 1st of January of this year, which is some 1,652 days, if I'm correct, after the historic referendum in 2016, and the end of the one-year transition period, which you mentioned earlier, the UK indeed left the EU, its single market, and the customs union. And for many in the UK, this was the accumulation of a long and at times acrimonious negotiation with the EU that would free the country of the alleged control of Brussels and allow, somewhat nostalgically in my view, by the way, the country to become a global Britain once more. In this, the final of my series of EUI podcasts and seminars on Brexit and the financial markets, I intend to focus on the impact of Brexit on, firstly, the regulatory framework, secondly, on the financial markets themselves, and lastly, consider the impact of Brexit on the financial markets ecosystems, as we call it, in the EU and in the UK. But before doing so, I'd just like to briefly consider the background to Brexit, and please bear with me on that. Firstly, I think to say over the last 3 decades, the City of London has expanded to become one of the world's leading international financial hubs. It employs about 1.1 million people and contributes around £75 billion in UK tax revenue. Access to the lucrative EU single market has been central to London's position. In 2019, the EU accounted for nearly 42% of the UK's net financial services exports. Secondly, the EU financial ecosystem itself is dependent on wholesale services originating from the UK financial markets, infrastructures and firms. This is especially the case for derivatives clearing, with UK clearinghouses processing almost 90% of all over-the-counter derivatives contracts concluded by euro area financial institutions. Thirdly, the disruption of these long-established and complex web of interlocking interests by Brexit will also have far-reaching implications for the UK's own finance-led growth model. It poses profound regulatory and financial challenges to the EU, notably the ECB, the EU 27 national competent authorities, as well as the UK's financial regulators, in upholding what is in all our interests, financial stability, especially when faced with challenges like COVID and the post-pandemic economic recovery, in which banks and other financial institutions will have to play such a critical role. And finally, Brexit will impact the EU's continuing build-out of its capital markets union, which I will touch on later. Now, for the politicians to claim that Brexit got done effectively in January, physically leaving the EU is only the end of the beginning of the process for the banking and the finance industry here on in.
Indeed, the Brexit process is still ongoing and will probably carry on for a long time ahead still. But focusing on the past 6 months of the current year, what happened concretely for the UK and the EU after the 1st of January 2021?
Well, that's actually quite interesting because counterintuitively, considering the profound economic importance to the UK and to the EU, which I've just sketched earlier on, financial services were actually left out of the EU-UK negotiations by and large on their future relationship. In the UK-EU Trade and Cooperation Agreement, known as TCA, well, it was finally agreed at the very last minute on the 26th of December 2020, no new provisions for financial services were included, citing the need for further information to assess the UK's intentions to diverge from the EU rules in the future. Now, this had three important consequences. Firstly, on the 1st of January, there being no proper agreement for financial services, UK-based financial services firms immediately lost their lucrative passporting rights, permitting them to trade in other EU member states on the same basis as they. Since January 21, UK firms are instead subject to existing EU third country rules, which important implications for the structure and strategy of financial firms, their ability to serve EU customers, to access the EU market infrastructure, and relations with regulators and supervisors in the EU. Secondly, there are no equivalent assessments covering financial regulations allowing the UK-based financial firms outside the EU to conduct business with domestic EU customers without being subject to host country regulation. Very briefly, this is quite important. EU equivalence, which tends to be quite complex, lengthy, and highly politicized, is the idea that if a UK financial regulator adopts the same regulatory standards as the pan-European regulator, the European regulator will continue to allow UK-based firms to operate as they did until the 1st of January of this year, and vice versa. However, in the negotiations, this proved not to be acceptable to Europe, as the EU felt they had no direct oversight by the ECB, ESMA, and others of the rules-based UK control framework. And it also reflected the widely held fear in the EU 27 that the UK would seek to lower regulatory standards on the other side of Brexit. In fact, equivalence was not acceptable to the UK either. It felt that it would become a rule taker. Rules set by the ECB and others with no future say in regulatory rules that could be cancelled by the EU at 30 days' notice for third countries that the UK has become. Instead, UK policyholders argued that they're committed anyway to maintaining the highest standards, whilst tailoring, in inverted commas, the UK framework to suit the unique nature of the new global financial services in the UK. Thirdly, faced with the position on equivalence and faced with the loss of passporting as EU law ceased to apply, the UK regulators then quickly put in place a new financial services regulatory framework from January 1 of this year. And to mitigate the impact of the transition, UK regulators signed a memorandum of understanding with European supervisory authorities to, quote, ensure continued good cooperation and exchange of information, end quote. Earlier in November 2020, the UK also announced that to protect itself and avoid potential cliff edge effects, it would unilaterally recognise many areas of EU financial regulation as equivalent to UK rules, enabling UK-based banks and fund managers to continue accessing EU exchanges, investment firms, credit rating agencies, and clearinghouses. This so-called temporary permissions regime allows relevant EEA financial firms and funds that had previously operated through an EU passport in the UK to continue operating temporarily, and that's a very important point. In response, the EU regulators did grant strictly time-limited equivalence ruling in the important areas derivatives trading, 18 months for UK clearing houses till June 2022, and 6 months for central securities deposits, reflecting the continued reliance on EU firms on London for euro-denominated clearing, at least for now. But let's be clear, the net effect of these last-minute activities in the run-up to January of this year, the UK has only ended up with 2 equivalence decisions for its central securities deposits and another for central counterparties. These two decisions, out of potential 39 equivalent agreements envisaged under the EU financial services law, this truly is a far cry from the permanent and comprehensive equivalence that the UK was asking for a year ago and the EU had agreed.
You have sketched different priorities and positions of both parties, namely the EU and the UK. But in the middle of these two, we have numerous financial actors who had to respond to ever-changing regulatory, political, and market trends. So what were the actions that financial markets undertook at the very beginning of 2021?
Well, yeah, again, very interesting because effectively since the referendum in 2016, the financial markets and indeed regulators have been preparing for a hard no-deal Brexit, at least for financial services. And of course, this came to pass, as I've just sketched, on the 1st of January of this year. As I highlighted in earlier podcasts, after the 2016 referendum, we saw a material headline shift in terms of numbers of firms, assets, staff, operations, etc., moving from the UK to the EU. More than 500 firms in the banking and finance industry in the UK have relocated part of their business, moved staff, or set up new entities altogether in the EU. Banks have moved or are moving more than £900 billion in assets from the UK to the EU, and insurance firms and asset managers have transferred more than £100 billion in assets and funds. Few, very few, however, were prepared on what happened on the 4th of January of this year, the first trading day of 2021, when nearly €6 billion of EU share trading immediately shifted away from the city to facilities in European capitals. Trading in equities such as Santander, Deutsche Bank, Total moved to the EU, and business on London hubs of euro-denominated share trading, including Chicago Board of Exchange Europe, Turquoise, etc., shifted to their new EU ventures set up recently mainly in Amsterdam to cater for the end of the Brexit transition period. Quote, "The city has permanently lost its European share business," end quote, as one commentator noted. Apart from this dramatic shift in equity trading, trades worth a notional £2.3 trillion in dollar, sterling, and euro swaps contracts by March of this year were redirected from the UK to legally compliant trading venues in America and in Europe, mainly in Amsterdam again, according to data released by IHS Markit. The swaps market has been fractured since January as British and EU regulators insisted that banks and brokers they oversee must trade the most active standardized swaps contracts on marketplaces in their own jurisdiction or in countries that have been passed as having an equivalent standard. As there is no equivalence, neither regulator recognized the trading venues in each other's markets, even though their rules are virtually identical. Consequently, by April, as post-Brexit activity started to settle somewhat, 16% of the global market for trading euro-denominated interest rate swaps had migrated to the US, compared with virtually nothing in December and 11% in the first quarter. Now, you may well ask why this had gone to the US and not to the EU. That's because traders have used local markets or sent their deals to US venues, which are known as swap execution facilities, because, ironically, both the EU and the UK deem American standards legally acceptable, but not each other's. Lastly, EU carbon trading, which is such a critical part of the recovery program set up by the European Commission in the wake of COVID, is set to move from London to the US-based Intercontinental Exchange, ICE, that will move the carbon contracts, a critical part of the EU's flagship policy in climate change, to its ICE exchange in Amsterdam, which will now become the world's biggest carbon trading market, handling more than €1 billion of contracts per day. ICE was pushed into this move by the EU's refusal to recognise most of the UK's financial services-based rules as equivalent.
Now, in describing the scenario, you rightfully highlighted the challenges of equivalence, which is one of the key challenges for European regulators. So what will happen from now onwards? Could you sketch the most probable avenue for the future relationship between the EU and the UK?
Yes, so in my view, as Brexit beds down, EU regulators are likely to apply existing rules on the location of individuals and activities ever more stringently, and in doing so trying to repatriate more activity in more sectors, such as asset management, clearing and trading, to Europe. This conscious uncoupling will also provide a boost to the EU's efforts to develop strategic autonomy and increase its capacity in banking, finance and capital markets, and potentially injecting more urgency into the Capital Markets Union, or CMU. The shift in euros share trading from London to Amsterdam in January quickly crystallized the minds in the EU and the UK. Brexit has reshaped the landscape of financial centres in the EU. Instead of one dominant financial hub, London, post-Brexit, the EU now has a series of polynodal nubs in different sectors with an injection of critical mass. For example, Frankfurt has taken on the crown of banking, as it were. Dublin is the place for asset management, Amsterdam for broking and derivatives exchanges. On the other hand, Paris has less of a sectoral focus like the others and could become the closest holistic EU financial centre to a mini London. This conscious uncoupling is also evidenced by the failure to date to sign the Memorandum of Understanding agreed in March of this year. On paper at least, the agreement of a Memorandum of Understanding on EU-UK Financial Services Cooperation could have been a significant waypoint on the road to a stable future relationship. But as things turned out, it came and went with barely a whimper. It merely provides for twice-yearly forum, a kind of a talking shop, to discuss areas of regulatory cooperation and a bilateral exchange of views on supervisory issues and equivalence discussions. This broad and non-binding commitment to regulatory cooperation between the EU and UK is noticeably different from the guaranteed single market access that UK financial services enjoyed until the 31st of December 2020. Importantly, this talking shop or forum will not restrict the ability of either side to implement regulatory measures that they consider appropriate. And that's really, really important because it signifies, in a sense, the beginning of divergence. And it then adds, in the interest of clarity, that the MOU, quote, does not create rights or obligations under international or domestic law, nor will there be financial obligations resulting from its implementation, end quote. Effectively, in my view, the MOU underscores the EU's unwillingness to move to equivalence and continue its uncoupling from the city. Now, while some in the UK still forlornly pine for the long-hoped UK equivalence deal between the EU and UK, allowing smooth mutual market access, this is, in my opinion, ignoring the politics of Brexit. Most now appear to have given up on the prospect of an EU-UK equivalence, even if a perverse outcome may be that some London activity, such as the derivatives trading that I mentioned earlier of swaps, is in future routed through Chicago and New York, thanks to the EU's equivalence deal with the US, but not, of course, the UK. The UK loses even if the EU does not gain, and the EU-UK relationship looks set to be structurally adversarial, in my view, for the foreseeable future. In truth, I think, the extraordinary amount of time, effort and money that has been spent on preparing for Brexit has been a huge missed opportunity for the industry and for regulators to address other concerns and challenges, such as building a bigger and better capital markets in Europe in the context of the CMU. Brexit inevitably means that the regulatory framework in the UK and EU will diverge. But akin to the earlier shift in euro equity trading in January, this divergence is happening more rapidly than I anticipated. Thus, the UK is already reviewing its equity listing rules, its Solvency II agreement, and the UK funds regime and the regulatory framework. Meanwhile, the Bank of England is preparing its first significant break from EU regulations with a proposal that would make bank capital rules tougher in the UK than in the EU. The EBA decided in October 2020, for example, that lenders should be able to count investment in software towards their core capital levels. For example, if a bank spent €100 million on a new trading system, then much of that can now be counted as loss-absorbent capital. But the UK's Prudential Regulatory Authority has said that it had, quote, found no credible evidence that software assets can absorb losses effectively in stress, unquote. The EU is simultaneously reviewing aspects of MiFID II and Solvency II by strengthening incentives for institutional investors to hold more equity and refining the IFRS 9 accounting standard. These various processes will enable both sides to tailor their regulatory frameworks more closely to the nature of their financial services industries and will inevitably lead to agreed regulatory competition. Broadly speaking, then, the EU is seeking to boost business by requiring certain activities to be conducted in the EU, and the UK will seek to boost activity by making more firms want to do business in the UK. Interestingly, developments both prior to and since Brexit have shown that, for example, the build-out of EU equity market ecosystem into an efficient equity capital market in support of large caps and SMEs as well as mid-cap businesses have indeed been boosted, in my view, by Amsterdam becoming the premier market in Euro equity trading and the center of a number of EU-launched tech IPOs. This suggests that the EU could build a deep and liquid capacity for both private and public equity markets, even more so after Brexit. Likewise, the progressive shift in trading in swaps from London to the EU will help to increase financial flow fluidity between EU financial marketplaces. In the end, in my view, Brexit presents an imperative to draw a line in the sand. Brexit has been and will continue to be a hugely complex, time-consuming, costly, and distracting exercise for the industry and for regulators in the EU and the UK. It's critical, in my view, to move beyond the debate on how closely the EU should remain aligned to the UK in exchange for more access to EU markets. This access, in the end, is unlikely to be forthcoming, and both parties should now instead be recalibrating their capital markets frameworks to the increasingly divergent nature of their financial services industry.
Very interesting. Thank you very much, Jean-Jacques, for this podcast and for shedding a light on what may happen next in the EU-UK relationship in this podcast series on Brexit here at the Florence School of Banking and Finance. Thank you for having listened to this podcast by the Florence School of Banking and Finance. For more information and to listen to all our podcasts, visit the webpage fbf.ui.eu/podcasts. Podcasts.